The silver to commodities ratio has reached old highs. It looks like a potential triple top, but it won't be a triple top because the silver to commodities ratio will continue to rise, meaning silver will continue to be more valuable relative to other commodities as its monetary nature slowly creeps out of its hole where it's been since 1980. And good news for all miners, including our sponsor Fortuna Mining, symbol FSM, that the gold to oil ratio is at its second highest ever, if you exclude that crazy time when oil was priced at negative $35 a barrel, when of course the gold to oil ratio at that point went to infinity.
The financial world is bracing for a potential crisis, as highlighted by Bloomberg and financial commentator Rafi Farber. Concerns are growing around the repo market, where the Federal Reserve's reverse repo facility is running low. Farber warns that this could lead to a sharp spike in repo rates, similar to the turmoil of September 2019. If banks are forced to become the primary lenders, significant market stress could follow. In Brazil, economic instability is worsening as the real nears historic lows against the US dollar. Farber points out that political tensions, including a crackdown on free speech, are heightening fears of hyperinflation, putting further pressure on the already struggling currency. In the US, money supply growth is slowing, indicating economic challenges ahead. Farber notes that the Federal Reserve's increasing losses are turning parts of the monetary base into deferred assets, which could destabilize the financial system as more dollars become unbacked by real value. Amid these risks, Farber emphasizes the growing importance of silver as a safe haven. The silver to commodities ratio is reaching new highs, signaling that silver's value as a monetary asset is rising. Investors may find silver a crucial asset to hold as the financial landscape becomes more uncertain. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and hit the like button so you help us spread gold and silver news. Enjoy the episode.
Endgame. Well, the first thing I'm going to cover today, just because I felt like it, is Brazil. Lots of news out of Brazil. That freedom of speech, or the last bastion of liberty as we know it, is under attack in Brazil. It looks like X is going to leave the country. We'll see what happens to its currency as this attack progresses. It's probably not going to be very good. We already see that the Brazilian real is near an all-time low versus the US dollar. This goes back to 1995, but I have the chart here from 2000. Once this support zone is broken, the real could collapse here, especially given the political developments in that country. And we have here the inflation rate of the Brazilian real supply, meaning how fast is it increasing. We can see here very clear stages in the inflationary destruction of this currency. We have the rate of pre-2008 when the slope of the line was over here in green. And then I changed it to red as we got from 2008 to 2020. The slope was pretty consistent, much steeper than it was pre-2008. And now we are in the deliciousness phase because I decided to call it that. It sounds nice, and maybe I'm a little bit hungry. So we have here the deliciousness phase of the hyperinflation of the monetary supply in Brazil. And we're going to reach another stage pretty soon where the curve with the slope is going to be undefined, as I learned in Algebra 1 in 8th grade or 9th grade. No, actually 7th grade. Whenever that was. The slope is undefined in a vertical line. So when we get to an undefined slope of monetary expansion, that's when you have hyperinflation. And, we're almost there. This is the silver to commodities ratio, and it has reached what looks like the high. I'm excluding these two highs here, the one from the 2011 top at 50, and this one from when commodities went way, way down in a lockdown frenzy that cured everything and solved all our problems. Yay, lockdowns. So it's here, this really is the practical top of silver to commodities. It was the top from 2011 all the way to 2013. And we reached it here in the 2016 top in gold and silver when the bull market resumed, at least in dollar terms. And then we're at it again. But I think this time we're going to break it in a sustained way, not in this way of 2011 top or the lockdown way, which gave gold and silver an unfair advantage as other commodities went down because people were locked in their homes. But here you see that silver is slowly coming out of its monetary shell and showing that it rises over time versus other commodities, as it should and as it will continue to do. This chart is brought to you by our sponsor. Not literally, I put this chart in, it's my decision, but it could be brought to you by our sponsor, Fortuna Mining, symbol FSM. This shows you the gold to oil ratio since 1974. And the red line is where we are now at about 33.568. That's the close in the upper right corner over here. And so I drew a line to see, have we ever been above that ratio? And the answer is, excluding this infinity thing here during the lockdowns when oil went negative, we were above it one time during the February, I think it was February 2016 oil crash from December, maybe February 2015, 16, something like that. Yeah, it looks like February 2016. That was when oil crashed, I think, to about $35, and as opposed to negative $35 over here. But excluding that crash and this crash, we have never been at this ratio. It is the highest, second highest ever. If you count this as one, then this is number two. What does that mean? That means that profit margins for miners, for example, like Fortuna Mining, are near record highs. This is the baseline for miner profits, gold and silver miner profits, because what do? They buy oil and they sell gold. And moving to page 9.
In today's news recap, silver looks ready to rip. Last Friday, United States Federal Reserve Chair Jerome Powell said, "The time has come to begin lowering interest rates, a process that will likely begin at the Fed's September 17 to 18 meeting." Markets are widely anticipating a 25 basis points cut, or even 50 points if the economy looks weak and needs a stronger monetary boost. More reductions could follow before year's end. If the Fed follows through, it will cause bond yields to weaken further, the dollar to weaken more, and commodity prices to strengthen. When positive real interest rates, which favor bond investors, turn negative, it will especially affect gold and silver prices to the upside. Spot gold set a record last week on Powell's dovish comments. Gold's rally, which started in mid-February, is underpinned mostly by increased geopolitical risks, central bank buying, and slowing ETF sales. Silver has gained mostly due to buying in India, China, and so-called paper silver. Investors in July showed a renewed interest in silver ETFs, which had $300 million in inflows following 2 months of outflows totaling $1 billion, according to BlackRock's latest global ETP flows report via ETF.com. Now we'll show you the best clips of the latest interview, but first, subscribe and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
9 of 51 of the investor presentation for Fortuna Mining, we can see quarter 2 2024 consolidated financial highlights, just so you see where they've been going. Sales are up 64% from previous quarter last year. Adjusted EBITDA up to $112.7 million versus $44.4 million. Free cash flow rockets higher about 4 times, quadruples from 9.5 to 38.6 million. And finally, adjusted attributable net income up 2.5 million to 30.4 million. This is thanks to the accretions from the Ivory Coast mines, Séguéla specifically, and more mines will be coming online in the quarters ahead. So we can expect these numbers to go even higher. But from there, let's continue with the slides. This is the quarterly annualized money supply growth rate for dollars in the Federal Reserve banking system. So we have here this line over here is 0%. This means absolute deflation, anything below this line. And we've seen here that we were in absolute deflation from about June 2022 until turn of the year 2024. So almost a year and a half in absolute deflation of a shrinking money supply. There was a brief spurt in the inflationary rate here of increased money supply. And then we dipped below zero right here for, I think, 2 or 3 weeks. And now we're just above it. We're going to be meandering around the zero line for a while. That means that, we're running out of steam here. And if you look at the absolute money supply, this black line, I'll explain in a second. I drew this black line and put it as the trend line for 2010 until 2020. So this line represents the slope of these little bumps over here from 2010 to 2020. And then I took that line and I moved it up to see if the current slope of money supply growth matches the 2010 to 2020 trend line, and it doesn't. We're still below that trend line, even if you count from here. Even if you want to count the money supply starting to grow again from here, or just before the turn of 2024, we're still below that line and falling. So even though money supply is growing very, very slowly, and we're not back up even to this trend line from 2010 to 2020. Now, this is an interesting chart. I have to explain it. I contributed it myself. So this is the weekly losses of the Federal Reserve translated into percentage of the monetary base. This is how many dollars, what percentage of the monetary base is becoming deferred assets. Deferred assets are assets that do not exist, and they are on the Fed's balance sheet because they owe it to the Treasury. And this is the percentage of dollars per week that are backed by deferred assets, things that do not exist. We say that the dollar is not backed by anything, but it is. It's backed by some amount of gold, some tiny amount of gold, versus the amount of bonds. It's backed mostly by bonds. I think 92% bonds or treasuries. So those are the assets that back the dollar, except the deferred assets literally are not anything at all. So we have here 0.15288% of the monetary base per week is turning into deferred assets. If you do the math of 100 divided by 0.15288, you get a theoretical number of 12 years. In 12 years at this rate, all dollars will be backed by deferred assets. Now, obviously, there's going to be a crisis way before then. You don't need 100% of your dollars to be backed by literally nothing to enter hyperinflation. The actual amount you need is much, much lower than that. I don't know what the amount is, but it's not 100%. Right now, cumulatively, we're about 3.2% of all dollars backed by literally nothing. And this is going to rise as QT, quantitative tightening, continues, and the Fed continues to accumulate more and more losses every week. That black box there are the figures that I averaged in terms of what percentage of the monetary base we are losing to deferred assets every week, and that's how I came up with 0.15288. Now, finally, just a reminder that the ultimate endgame bell, when do we know that the monetary system is dead? We will know because of silver, the gold to silver ratio. That will be the bell. Why will it be the bell? Because silver is the public's money. And when the gold derivatives finally fall and gold goes to infinity in dollar terms, the gold to silver ratio will fall to 15 to 1. And you can see here on this chart going back to 1800 why this is. There's like a wall here, a hard wall that you can't get below. And this is the 15 to 1. It happened 3 times since 1873, the crime against silver. 1919 over here after World War I, 1968, fall of the London gold pool, and finally 1980. We're going to hit this one more time. Don't know when exactly, but it's going to be quick. It's going to be sudden. And it's going to be brutal for anyone who doesn't have silver.
What do you think of Rafi's analysis? Is he spot on, and do you agree with him? Post in the comments section your honest opinion and share your price prediction for silver going into year's end. Share this video with a gold bug and watch this video right here because it's a perfect fit for you. I'll see you on the other side.